Welcome to our comprehensive CAD/JPY analysis report covering the trading week of October 6th through 11th, 2025. In this video, we'll examine the critical price movements, technical levels, and fundamental drivers affecting the Canadian dollar versus Japanese yen pair. We'll provide both short-term and medium-term trading outlooks, along with key risk factors to watch. This analysis was prepared on October 13th, 2025, using data from multiple professional Forex sources including TradingView, Investing.com, Action Forex, and Daily Forex. Let's dive into the market dynamics that shaped this volatile week for CAD/JPY. As of October 14th, 2025, CAD/JPY is trading at 108.15 Japanese yen, showing a daily decline of 0.34 yen or 0.31%. The pair experienced significant intraday volatility with a range between 107.92 and 108.72. Trading volume reached 27,910 ticks, indicating active market participation. Looking at the broader performance picture, the pair is up 1.62% over the past month and has gained an impressive 5.63% over the last 6 months. The previous close was 108.50, and the current price action suggests consolidation after recent gains. The technical chart shows the pair testing key support zones while maintaining an overall upward trajectory on higher time frames. The week of October 6th through 11th delivered exceptional volatility for CAD/JPY traders. The period began with a powerful rally on October 6th, surging 2.02% from an opening price of 105.64 to close at 107.84. This momentum continued through October 7th and 8th, with gains of 0.98% and 0.50% respectively, pushing the pair to 109.44. October 9th marked the weekly high at 109.75 before sellers stepped in, triggering a minor pullback of 0.24%. The most dramatic move came on October 10th with a sharp 1.14% decline, dropping from 109.19 to 107.93. The week concluded with a recovery on October 11th, gaining 0.65% to close at 108.63. Overall, the pair traveled a remarkable range of 4.14 yen, ultimately netting a gain of 0.79 yen or 0.73% for the week. Several critical developments shaped CAD/JPY dynamics during this period. On the Canadian side, positive employment data released October 6th showed 60,000 jobs added in September, driven by manufacturing sector strength, which provided significant support for the Canadian dollar. However, this was tempered by a Royal Bank of Canada report describing the housing market as uneven and fragile, creating mixed economic signals. The Bank of Canada's policy outlook remains a key focus, with markets discussing a potential December rate cut following September's reduction to 2.5%. Meanwhile, Japan faced its own challenges. The Bank of Japan's next policy meeting, scheduled for October 29th to 30th, has markets uncertain about rate hike timing, with wage data being the critical factor. Political chaos and policy uncertainty kept the yen depressed, while Finance Minister Kato commented on one-sided rapid currency moves. Japanese equity markets reflected this uncertainty, with the Topix down 2% and Nikkei 225 falling 2.6% amid political and trade concerns. Understanding critical technical levels is essential for trading CAD/JPY effectively. On the resistance side, the 109.70 to 109.75 zone represents the recent high, where the pair faced sharp rejection, making it a key barrier for bulls to overcome. The 109.28 level serves as a pivot point, while 108.80 marks a critical liquidity sweep area where smart money has shown interest. For support, the 107.80 to 108.00 zone functions as a major demand area and potential correction target, with 107.99 identified as the first support level by multiple analysts. The deeper support at 105.40 represents a significant bearish target should the pair break down. These levels are derived from multiple professional sources, including TradingView, technical analysts, and institutional research. Traders should monitor price action around these zones carefully, as they're likely to generate significant trading opportunities in the coming sessions. For the next 1 to 2 weeks, CAD/JPY presents two distinct scenarios. The bearish case involves entering short positions below 107.80, targeting 105.40, with stops above 108.80. This scenario is supported by the break below the demand zone, confirming a bearish reversal, October's historically bearish seasonality for this pair, and the strong rejection from 109.70 to 109.75 resistance, suggesting uptrend exhaustion. Conversely, the bullish scenario calls for entering long positions either on a bounce from the 107.80 to 108.00 support zone or on a breakout above 108.80, targeting a retest of 109.75 with stops below 107.80. This approach is justified if the support zone holds, providing a base for another leg higher, and the weekly structure remains bullish, with smart money showing interest in premium buying opportunities. The key is waiting for clear confirmation at these critical levels before committing capital. Looking 1 to 3 months ahead, we assign a 60% probability to a bullish scenario and 40% to a bearish outcome. The bullish case requires the Bank of Canada to remain hawkish, the Bank of Japan to maintain its dovish stance, and global risk sentiment to stay positive. Under these conditions, we target a range of 110.00 to 112.00, with the strategy being to buy on dips, particularly focusing on the 107.80 to 108.00 support zone as entry points. The bearish scenario would unfold if the BOC signals a pause or end to tightening, the BOJ begins policy normalization, or global risk sentiment deteriorates. This would target 105.00 to 103.00, with the strategy being to sell on rallies near the 109.75 resistance level. The primary driver for the medium-term outlook is monetary policy divergence between the two central banks. The current policy stance favors Canadian dollar strength, but any shift in central bank rhetoric could trigger significant trend reversals. Oil prices and global risk sentiment remain important secondary factors to monitor. Let's examine the key risks and essential trading discipline. Upside risks include stronger than expected Canadian economic data, leading to a more hawkish Bank of Canada, continued Japanese yen weakness due to the BOJ's accommodative policy, a surge in oil prices supporting the Canadian dollar, and positive global risk sentiment favoring commodity currencies. Downside risks encompass a shift in BOJ monetary policy towards tightening, weaker than expected Canadian economic data, leading to a dovish BOC, deterioration in global risk sentiment, increasing safe haven demand, and political uncertainty in either Japan or Canada, affecting currency stability. For trading discipline, implement strict stop losses and never risk more than 2% of your account on a single trade. Avoid excessively large positions and consider scaling in gradually. Closely monitor economic data releases and central bank announcements from both countries. Be prepared to adjust your strategy based on changing market conditions, and maintain a trading journal to track decisions, outcomes, and lessons learned. Remember, this analysis is based on data up to October 14, 2025. Market conditions can change rapidly, so trade cautiously and implement proper risk management at all times.